about Beethoven. Hi, Dean Jenkins with FollowMeTrades.com, and this is the market update for the week coming up of March 11th, 2019. And I'm looking at the S&P 500 here on a weekly chart, and let's just kind of recap what we see here. We had a very long period of really impressive, bull market, prices heading up. We had a sharp correction, and then a pretty impressive recovery, and then signs of that recovery starting to emerge, of it rolling over Beethoven. Now, if you've got a sharp eye, you'll notice that the timestamp on this chart is not today. It's 2008. Well, why am I showing a stock chart from over 10 years ago? Well, because it looks shockingly familiar. And now I've expanded it. Here's that little rally we were talking about. Big run up, correction, rally. Wow, there was a really big drop. And again, this portion of it, the run up, sharp correction that we saw at the end of last year, what we've seen so far this year, pretty impressive rally up. Is this coming next? Yeah, I don't know. I don't have a crystal ball. But history does seem to and tend to repeat itself, particularly in the market. And there's a phenomenal article that I want to share with you that I can't repeat. This is pretty good analysis, but this is from Business Insider. And the article says, obscenely overvalued. Stocks are far more fragile than most people realize. One expert says traders are making the same mistake they did before the last two crashes. Article goes on to talk about the valuation of the current market and the tendency of traders, investors, when there's a rally after a sharp correction, to jump in and go, okay, everything's okay, and to not be so happy with those results. So what is the current S&P 500 valuation, the PE ratio? It's about 21. What was it right about here in 2008? About 21. So what do we think? Again, I'm not a doomsayer. I'm not a negative guy. I'm pretty positive. But I think we have to be prepared. We've got a 10-year bull market going on here. And we see a pattern setting up that is very similar to historic corrections. And I think we have to be prepared for that. Let me go ahead and reset the chart to current time now. So here we are, 2019, and what do we see? Really impressive run up, sharp correction, an impressive recovery, and signs of it turning down again. Is it going to do what it did in 2008? Again, I don't have a crystal ball. I think we have to be prepared for at least some more downside coming. In addition to the technical analysis on the chart here, we've got a backdrop of increasing reports of global slowing, predictions of recession, all kinds of stuff. Is that going to happen? Well, we don't know. We can't perfectly predict the future. But again, the market's been in a 10-year bull market, and the pattern we are seeing is one that has repeated itself several times. So I just think we have to be ready. If it heads up from here, we'll go long, but we are watching very closely. Let me shift this to a daily chart. It's currently on a weekly. And this pullback that we are seeing from last week is a bigger pullback than we have seen all year. And what it really looks like is this rally through the first couple months of the year looks like it's ending, and we're going to get some kind of pullback. Will it be a continuation like we saw in 2008 of kind of epic proportions? Don't know. We're going to be prepared. We're going to trade the realities of the market. So my bias is definitely to the downside here, and we're going to be watching close. We're already primarily short and in profit on those short trades. The Russell actually is leading the other indexes down. We're short the Russell. We're in nice profit on that in my pick service, and we're watching several others. So I just think we need to trade the realities, be nimble, be aware of what's currently going on and the historical context and the global context of it looks like global slowing economies. Earnings for the S&P 500 in the U.S. are low. They're coming in lower than they have been in a number of years. The valuation of the S&P 500 is pretty high. And again, the mistake that people have made time and time again is buying in at the top and getting hammered. Don't do that. Let's trade the realities. Let's be focused on what's going on, and if it's going to go down, let's make some good money. It goes down a lot faster than it goes up. So I'll continue to pay attention, to analyze it daily, to find the best trades, and to provide updates. But that's what it looks like right now, and I appreciate any comments you have, any feedback, any questions. But that's it for now. Watch closely, and let's be ready to capitalize on any opportunities that come up. All right, thanks.